When investors want diversification, professional management, and liquidity without needing to pick and monitor individual securities, they often turn to investment companies. These firms pool the money of many investors and put it to work in a diversified portfolio of stocks, bonds, or other assets. At the heart of it all, there are three main types of investment companies: open end funds, closed end funds, and unit investment trusts. Open end funds are what most people mean when they say mutual fund. These are continuously offered. The fund issues new shares whenever investors buy in, and it redeems shares whenever investors want to cash out. The price of these shares isn't set by supply and demand, but by the value of the portfolio itself, the net asset value, or NAV. The NAV is calculated at the end of every trading day. It represents the total value of all the securities in the fund, minus liabilities, divided by the number of shares outstanding. If a fund holds $100 million in assets and owes $5 million in liabilities, with 10 million shares outstanding, the NAV is $9.50. That's the price at which investors buy and sell shares. But there's one more number that matters: the public offering price, or POP. When a mutual fund is sold with a sales charge, the investor pays the NAV plus that charge. For example, if the NAV is $9.50 and the fund carries a 5% sales load, the POP equals $10. Some mutual funds charge this sales load up front. They're known as front-end load funds. Others charge when shares are redeemed. Those are back-end load funds. And still others use a small, ongoing charge to cover marketing and distribution costs, the 12B1 fee. Each approach changes how investors pay to access professional management, but all serve the same purpose: to spread costs fairly while keeping the fund operating smoothly. Mutual funds are categorized by what they hold and what they try to achieve. An equity fund focuses on stocks. It might aim for long-term growth, income through dividends, or a blend of both. A bond fund focuses on fixed income securities, corporate bonds, municipals, treasuries, seeking stability and predictable returns. There are balanced funds, which hold both stocks and bonds to manage risk. And there are money market funds, which invest in short-term instruments like treasury bills and commercial paper, offering stability and liquidity. Specialty funds might target a specific sector: technology, healthcare, or energy, or an investment style like growth or value. And then there are index funds, which simply aim to match the performance of a specific benchmark, like the S&P 500, by owning every stock in that index in the same proportion. They're designed for passive investing: fewer trades, lower expenses, and often more predictable results. Now, while mutual funds are open-end, constantly issuing and redeeming shares, closed-end funds are different. A closed-end fund issues a fixed number of shares through an initial public offering. After that, the shares trade on the secondary market, just like a stock. Their price isn't determined by NAV, but by what investors in the marketplace are willing to pay. That means a closed-end fund can trade at a premium or a discount to its NAV. If investors are optimistic, they might pay more than the fund's actual per-share value. If they're cautious, they might pay less. Because the fund's portfolio isn't constantly shrinking or expanding, its managers can take longer-term positions without worrying about daily redemptions. A unit investment trust, or UIT, falls somewhere in between. It's created for a specific period and holds a fixed portfolio, often bonds, that doesn't change. Once created, the securities inside the trust are held until maturity or liquidation. Investors buy units in the trust, not shares that can be traded. UITs are known for their predictability. There's no active management, just a defined basket of securities that slowly winds down as the trust matures. When it comes to comparing these three, mutual funds, closed-end funds, and UITs, think of it this way. Mutual funds are continuous and flexible. Closed-end funds are fixed and market-driven. UITs are set and hold. One of the key benefits of mutual funds, especially for small investors, is breakpoints, volume discounts on sales charges. The more you invest, the lower the percentage you pay in front-end load. For example, a fund might charge 5.75% for investments under $50,000, but only 4.5% for $50,000 to $100,000, and 3.5% for $100,000 to $250,000. This structure encourages investors to commit more capital by reducing their costs. If an investor intends to reach a higher breakpoint but can't invest the full amount immediately, she can sign a letter of intent, or LOI. That letter allows her to receive the lower sales charge upfront as long as she completes the intended investment within 13 months. There's also the right of accumulation. If the investor already owns shares in the same family of funds, the value of those holdings can be combined with new purchases to qualify for a reduced sales charge. All of this is designed to reward loyalty and larger investments while giving investors fair and transparent pricing. Beyond sales charges, it's important to understand what investors actually get from a mutual fund. There are two main sources of return: income and capital gains. Income comes from dividends and interest generated by the fund's portfolio. Capital gains come from the appreciation of the securities the fund holds, realized when those securities are sold for a profit. By law, mutual funds must distribute most of their income and realized gains to shareholders each year. That's why investors in mutual funds might owe taxes even if they haven't sold any shares, because they receive taxable distributions when the fund realizes gains. Reinvesting those dividends or gains doesn't eliminate taxes. It just means the investor is buying more shares automatically at the new NAV. Exchange-traded funds, or ETFs, share some features with mutual funds, but with a crucial difference. They trade intraday on the exchanges like a stock. Their prices fluctuate throughout the day, and investors can buy or sell them at market prices rather than waiting for an end-of-day NAV. ETFs are often structured to track an index with very low expenses. Unlike mutual funds, they rarely distribute capital gains, making them more tax efficient. For investors seeking diversification with the liquidity of a stock, ETFs bridge the best of both worlds. There's also a category of funds that combine professional management with defined payouts: interval funds and closed-end interval funds. These allow periodic redemptions at NAV, giving investors access to alternative strategies while limiting liquidity to set windows. Investment companies have one more shared benefit: they provide simplicity and oversight. The Investment Company Act of 1940 requires these funds to register with the SEC, disclose their objectives, policies, and expenses, and operate in the best interest of shareholders. The fund's board of directors oversees management, ensuring that investment decisions align with the fund's stated purpose. In a world where investors can choose between trading individual stocks or trusting a professional manager, investment companies remain a cornerstone of diversification. They allow ordinary investors to share in the performance of broad markets, specific sectors, or carefully curated portfolios without needing to build them from scratch. And whether it's a mutual fund, an ETF, a closed-end fund, or a UIT, the key questions always come down to the same three: how is it managed? How is it priced? And how does it fit into the investor's goals?